was just going to share my thoughts on the market sell-off, and more specifically, looking at the Nasdaq. And I believe that that's the one that's most critical, you know. And I feel that there's a lot of really negative sentiment out there that's distorting, how people are looking at the sell-off. Of course, this is normal, when the sell-off starts to really accelerate. People get extreme fear, and you could see this in a lot of ways. Look at like CNBC, running their header "Markets in Turmoil," and the headlines, everywhere. Market crushed. Um, Armageddon. One analyst said, blood in the streets, wipe out. All these words. And I just keep in mind about a week ago, everyone was, comfortable patting themselves in the back. The Fed, did the rate hike as expected, and they didn't do or they're taking the 75 rate hike off the table. So it's not going to be an issue, and that was so positive that the market rocketed up, for one afternoon, and then of course it came down hard the next day, and into Friday it was like a capitulation sell-off into Monday. So looking at Friday all day into Monday all day, well, maybe even like an afternoon of Friday into Monday. So just like a day and a half, the market tanked about 11% on the Nasdaq, and altogether it lost, I believe it's over 25% now. So this is the point, I think, where with all this going on, with the extreme negativity and the large sell-off that we've already had, just in a day and a half, down 11%, and that's massive. So I think we're kind of exhausting the selling, and another big factor too is the institutional investors have been buying. They've been buying. And the retail investors who were buy the dip and kind of haphazard investing, maybe, with a lot of this, Tesla calls and, a little risky, definitely risk on type of trading. And they were doing that even as the market was selling off. And it was only very recently when they turned this, extreme bearishness, and it was probably tied to, there's a chart out there of the profits of the stocks held by retail investors, and it has gone down to zero. So from January 2020 to now, they have zeroed out. They're as a collective group, their profits are gone. So they're not selling as much right now because there's probably not a lot to sell. They've already sold it in the last few days, as the institutional investors are stepping up to the plate and taking them from the retail investors. So, looking at the charts, I have a few charts here that are up that you can see where there's like a descending triangle, and it kind of is coming down to the lower support line. Now, that support line, it could be about 12,200 to 11,800. That's the zone that I would say, a little above, a little below. The 1200 is going to be a battlefield. That's not going to go easy. And the same with the S&P. Like it sold off through the 4,000 on the futures in the evening session. So, that's a battlefield number in the S&P. There's no way it's just going to rip right through the 4,000. It went through it, but it's going to go right back over it, and then there's going to be some choppiness, I think, coming out of May. A lot of choppy trading, some short covering rallies, and then, bringing it back down, and you're going to get this, not an extreme volatility, but sort of this medium volatility as it kind of works out the bottom here. I don't think this is going to be that big V bottom and shoot right back up, to 14,000 and 15,000. I don't think that's going to happen. I do think later on in the year, I don't believe that this market's just going to keep on just dwindling down, to these super low numbers that these analysts are throwing out there. I saw this one, it was saying 3,000 on the S&P at the end of the year. Now keep in mind, all these analysts, I've seen their articles and on Zero Hedge. They really just posted these the ones that I'm looking at with the headlines of blood in the streets and all this end of the world kind of headlines. These are just in the last few days. So I mean, these people weren't saying this, other than Grantham. He was saying it at the top, but he's been saying it for a year at the top. But these analysts now who are calling for blood in the streets, they're just posted that in the last few days, along with the retail investors who are selling. So it's kind of new that they really ratcheted up this fear. And I know there's like this little gauge out there that shows fear, and it's somewhere in, I think, the 30s right now. But that, I think it's not really, that's, I don't know where the data for that, I'm not sure where that comes from, but, I just look around me and I see the headlines and like, I'll see like other YouTubers channels, what are they posting, and everyone's extremely bearish. Like I've never seen it this bearish for myself. Everyone's calling for like, S&P 8,000 and stuff like this. Not 8,000. I'm thinking Nasdaq 8,000. So just a really, really pessimistic environment out there. Now you've also got high put call ratios too, that are also going to have a lot to do with the bottom being formed. And if you look at like barchart.com, you can go see. You can scroll down through the different days, of May, and you can see that they're well over 1 ratio on almost every day, and much higher actually. And some days it's over 4. So I mean, these are insane, 4 put call ratio. So that's extreme, and so you have a lot of these extremes really kicking in, plus the battle zones here at these 4,000 S&P and the 12,000 Nasdaq. That tells me this is sort of the bottom right here for now. Like we could have a bottom later, but I think for now, we're probably gonna, like I said, have some volatility here. Retail investors, hopefully the ones that were in there real risky, hopefully they come back in again, and they're invest a little differently, a little bit more conservatively, hopefully learn some lessons. I think the institutional investors are going to continue to buy. They're getting these, amazing deals, the ripe fruit hanging on the limb. It's right there, and they're picking them up. And other factors I think that are really important that you have to look at as far as this market and why I think it's not going to do so badly as everyone thinks, like throughout the rest of the year. I don't think there's a lot of good places to invest. I mean, geographically and other investments like bonds or commodities. I don't think that these are looking good. I mean, why would you invest into commodities going into a recession? Yes, they're going to have some inflation, but you're going to have a lot of recessionary demand destruction, and you're going to have a lot of earnings hits on a lot of companies too because of the recession, and of course, they're not going to be. You're not going to be. The PPI is also it's going to go down. When they're not going to use as much commodities. So copper is already coming down. Oil's coming down. Um, so you already have that playing out. So maybe playing against some of these commodities isn't a bad idea. Oil's looking like it's kind of peaked out. In the oil embargo thing with the EU, it looks like that's not going to go. There's too much opposition from too many countries that's not going to. They're not going to come up with that. Even if they somehow did, it would be a long time. So that's off the table. So oil's going to come down from that, and also like the industrial commodities. You look at like China and their demand is really slowing down because of the lockdown situation, and their economy's really getting hurt. So these big commodity miners like Rio and Vale, they're gonna get hammered with this. So I don't think commodities and bonds, definitely, the bonds are getting, wrecked. Um, I mean, speculating in bonds, and it might be a good idea. It's probably peaked and it's probably going to come back down, because you have to think about there's a recession. I don't think they're going to do all these rate cuts that they're talking about, because you have two things going head to head. You got this inflation and trying to get that under control, and then you have this recession. It's like guaranteed. I mean, look at China; it's crushed from the lockdowns. Europe is crushed. So there's no way Europe and China is not going to be severely affected by this. So you're going to have a global slowdown, and even if you think somehow the United States is not, it's going to be affected. So you're going to have this demand destruction. You're not going to have the supply chain woes is extreme because the demand will be less from the producers, and that they require the commodities. It's not going to be as the need is not going to be there. So you're going to see the PPI come down. You're going to see the CPI come down, and once these inflation numbers start turning and going down, that is going to be super bullish for the stocks. That's going to happen. Whether it happens on Wednesday or it happens, a week later or whatever, it's happening. And just you look at like copper and some other commodities, it's already starting to come through the pipeline. So you're going to see that come down. The dollar is probably going to start to come down too. So these are really going to be super bullish for stocks. And also, going into the recession, you're going to have the Fed start talking about the economy slowing and that they can't raise rates. Now, of course, they're going to have their words and of how they're going to word that, so it's not going to sound, that way. They're going to make it, they'll spin it, but that the inflation's being tamed and it really was supply chain oriented and blah blah blah, and they're not going to admit that the economy is slowing down so much. They'll probably say that the they'll use like other wording for that to make it sound more positive. But that's what's going to happen. The economy is going to slow down. So the whole thing right is the interest rate stuff. And everyone's seeing the bonds. Up there. The 10-year notes at 10.2 or something like that. I mean that's going to come down. And so that's going to be into the dollar, and that comes down. These are two like mega catalysts right there, and they're going to come down, especially when the recession starts people start realizing that that's going to be the new thing to talk about. Right now it's all inflation, and so everyone's like focused on the rates, and you got to raise rates, you got to go up to 10% right away, and all these people are talking like this, but that would be catastrophic if they did that. The Fed's really in a bind because they screwed up policy so bad that when they needed to raise rates, they didn't, and I don't even want to get into all that, but they're running up against another problem that they caused partially. So this is this is what they're doing, and they weren't prepared because they didn't use the tools at the right time. And they're behind, so extremely behind that they can't do anything anymore. It's the only thing they can do is cancel the rate hikes. So you may get one more rate hike, and then it's going to be that could that could cause a little sell-off too if people realize that's a bad policy decision, because then you're going to start seeing the economy really slowing down, and everyone's going to be like, we shouldn't do that, and so I think that the whole narrative is going to change from this whole inflation thing. It's going to change over to this kind of recessionary, the global slowdown kind of thing. And this is going to be the dominant narrative going into the second half of the year. So that's just my thoughts on all that. And I know I kind of rambled on about all that, but I think it's important. I mean, as far as the logic of why I think the markets are going to be somewhat more resilient than what people are thinking, just because there's not much places to invest. And you're probably going to see the reversal of these things that were causing the extreme fear catalyst. That would be, the seeing the rates over like 3% and the dollar, way up there near like 104, and oil way up there, and all these commodities are overpriced. Or parabolic rather, I'm sure they're fairly priced at that time. So, you have to look at that these catalysts are all going to start to reverse, eventually, probably sooner rather than later. But I do think the market is totally exhausted on the sell side, and that we are definitely ready for some kind of a bounce here, or like a choppiness going into May, into June. That's just my thoughts. And I don't know, I hope somebody got something out of this.